Hello my friends, welcome. You can see today I'm in the flow producing several videos. So let's keep the momentum. I would like to comment a little bit on risk management within this short video. And again, rather than doing a very elaborate PowerPoint, I just would like to stress certain very fundamental, essential aspects, okay? Risk management in trading, ladies and gentlemen, is super important, okay? Most traders fail when it comes to that particular topic. And as I wrote here, the best traders are obsessed with risk. The best traders understand that whatever return they make, this return comes at a price which represents the risk they're taking. For example, if someone doesn't use any stops and just places trades on the market, they're taking a massive risk because their complete account is at risk. If one single position makes an extreme price spike, the account can blow up. As simple as that. Professional traders have a very clear risk policy. Professional traders use stops. Yes, there are different ways of using stops. There are stops per trade. There is also equity stops and all these things. There's hedging, etc. And beyond that, professional traders understand the importance of risk return. But let's go step by step. When it comes to the risk per trade, as a general rule of thumb, you should not risk more than 0.85% per trade. Now, 0.85% implies the best trade setup. Whenever you have a minus point on the checklist, you obviously reduce this maximum risk per trade. Yeah. So let's say you want to trade it for a reversal, you have a dumb money switch, but the low has not been cleared. Of course, you subtract 0.3% from that, and then you subtract again for other minus points. Okay? The 0.85% refers to the best trade setup, high confidence trade. Also, if you place a long trade in Australian dollar, if you want to also place a long trade in euro dollar, those two pairs are very correlated. So you can't do that. You will need to split up the 0.85% between those. Also, if your plan is to have several entries and to scale into the position, of course you divide this percentage by 2, 3, 4 times, how often you want to scale in. Alright, you understand that? So professional traders are very, very precise with regard to these aspects. Okay? They will not just blindly, generically risk 0.85% of the account. Alright, so if you trade a very small account, maybe you will increase that risk per trade slightly because in absolute terms you want to risk a little more, but understand, trading is a percentage game. If you don't have much money to trade, you should still treat those percentages of the risk policy as if you're trading a massive account. That's what this game is about, okay? Risk return is important because even if you use a stop for each trade, if your risk is twice the amount of the return you could get for one trade, it will just take you a few losers to be in net loss. Risk return has to be balanced and, if possible, be positive. I know it's sometimes difficult on the lower time frames in particular to get a very good risk return. But whenever you see an opportunity, let's say you want to trade an MTS run and you see this is traded into a 4-hour reversal, which could go all the way to the opposite channel band, then sometimes maybe take a partial profit and let the rest run, or let the whole position run, yeah? Especially if there are no dumb money positions in the way. So let's talk more precisely about what the different factors are when it comes to reducing your risk per trade. Of course, it's the quality of the setup, all the aspects of the market causality. Is it dumb money on your side or on the other side? Is there an immediate term stop? Is there a short term stop, long term stop? Is it a 4-hour reversal story? Is it an option strike target? Is it an order gap zone on the way? Are you in a squeeze mode? You know, all these known factors are relevant. Then also, what news announcements are coming up? Okay, don't place a trade if in 2 hours there's a big news announcement coming unless there's a high bias, for example. How do you manage weekend gap risk? Yeah, whenever you hold a position over the weekend, there's gap risk unless you are clearly on the opposite of the money squeeze. Yeah. Pair correlations, as I said before. Yeah. Your position, how is it correlated to other trades? Black swan aspects. What happens if the internet gets cut, your machine crashes, there's a fat finger event, etc. How do you enter via market order, via limit order? Sometimes it makes sense to actually not enter immediately, but to wait and place a limit order to say, you know what, if this high gets taken, I want to be short, for example, in a post stop hunt trade, etc. Timing is of course important. All right, these are some very fundamental aspects, but understand we are not gambling. If you have a high risk per trade and you have a drawdown, it will take you a lot of good trades to come back up. Yes. You need to have a certain mindset when it comes to risk management. You need to take it seriously. The worst is like forex rookies who just trade without a stop and just over leverage and then do freestyle trades. This combination leads to blow up sooner or later. If you have done a lot of strategy testing, you will know how most strategies will blow up, how even strategies which look good on paper will eventually just result in a downward sloping account curve over a long period of time. You will understand how important these factors here are. And that needs to be all in order if you want to trade professionally and correctly. So this channel is normally focused on the market analysis, on predicting and understanding all that, on the leading information. But of course, these aspects here are essential as well. If you read Market Wizards, you will see that, you know, apart from the fact that all the traders have completely different strategies and setups, they have one thing in common. They all know exactly what risk they are taking. And do not listen to rookies who say, oh no, it's not all, I will break all the rules. In 99% of the cases, this will lead in a complete blow up. And, you know, you are not an exception to the rule. So be very smart. Take smart risks. Trading is all about taking smart risks, calculated risks. We are not gambling. Trading is the opposite of gambling. Okay? You don't know which trade will be a winner or loser, but you know overall that your approach works and has merit and is proven. The market causality is a proven edge. So all you need to do is have to have your risk management in order, reasonably, and as I said before in the other videos, to have the right mindset and to organize your life around that activity in a reasonable manner, to take it seriously. The same way you would write a business plan for a startup, you should write a trade plan for your trading, and you should be very concise about what kind of risks are you taking. If later on you're successful and you want to take on investment capital, etc., you need to be able to explain to your potential investors at what kind of risk parameters you were able to achieve the return. Okay? They are interested in that, especially if they are experienced investors. They know what the deal is. They understand what kind of risks you're taking and what they potentially will sign up for. So it's important to explain also what are the drawdowns, what are the parameters, and what the respective policy in place is, so that everybody's on the same page regarding potential downside and what kind of parameters the traders can work with when it comes to scaling up, scaling down, becoming more aggressive, becoming more defensive. These are all fundamental skills an experienced trader has.